If your trades feel like a coin toss, then you're not trading, you're gambling. It's not the market, but it's the setup that needs work. So let's build your very first high probability of profit setup together. Hi, I am Pranav K, an NISM-certified trader and trainer and your friendly guide at Stockshaala by Kotak Securities. In the last few videos, we discussed about price structure, indicators, and so many other aspects of trading. Now, it's time to bring it all together to build a high probability of profit setup. So, what exactly is a trading setup? A trading setup is not a magical signal. It's a repeating situation in the market where you understand the logic, you wait for confirmation, you define your risk to reward clearly. Think of it like a trading recipe. Not every ingredient is fancy, but each ingredient helps you get consistent taste. So here's a simple 5-step framework that anyone can apply to create their own trading setup. Disclaimer, this is not any kind of financial advice, but just an approach of how you can build your own high probability of profit trading setup. So here are the 5 steps of the framework. So the first step is identifying the market structure. The second thing is you need to spot a confluence zone. Third, you have to wait for triggers. Fourth, define your entry, stop loss, and target. And fifth, then make the decision whether or not to take the trade. So let's start with the first point, that is identifying market structure. Here in the chart, I have taken the 1-day time frame of Anand Rathi stock, where I have marked the higher highs, higher lows, lower highs and lower lows as well. So this gives me a first impression of what exactly is the trend of that specific stock. Now that I know that it's clearly in higher highs and higher lows, which means the stock is in uptrend. Now I will also mark the support and resistance lines that will help me to make the further decisions. As you can see, this is the most recent all-time high of Anand Rathi. So I'm going to draw a line here. And I'm also going to draw a line at this specific support level. And also at this specific resistance level. Now we have a clear picture of what exactly is the trend of this specific stock and where are the most recent support and resistance levels. So that's step 1. Now step 2, spotting a confluence zone. What exactly does it mean? So spotting a confluence zone involves you identifying if the present price is near any strong support or resistance, or is it retesting any specific level, or is there a bullish engulfing or a bearish engulfing candle that can give you an entry point. So let's get back to the chart and see if there is a confluence zone. So coming back to the stock of Anand Rathi, you can see that the present price is at 2,798. And the support and resistance that we have drawn so far, it is not near either of them. But it is near this specific resistance that is the all-time high of this specific stock. Now, if there was a bearish engulfing candle at this level, then it could have been a confluence zone or a signal for us to go bearish on this specific stock. But at this point, it is in a state where we cannot make any specific decisions. Think of confluence zones like traffic near a junction. When there's multiple factors that meet, there's more action. The third step in the framework is waiting for the trigger. The trigger is your green signal for you to enter the trade. It could be a bullish engulfing candle, a bearish engulfing candle, or even RSI crossover 40 in an uptrend, or even MACD along with a volume spike. Here is an example of waiting for a trigger in the real markets. As you can see here, imagine you were on 14th of July 2025 and you had this volume spike, and which also coincide with the MACD crossover. And this could have been a very good entry point, and after which the stock has broken out multiple levels going higher and higher. This is how waiting for the trigger can help you enter into a very high probability of profit setup. Now that we have identified the market structure, spotted a confluence zone, and also waited for the trigger, now it's important for us to define our entry, stop loss as well as target, and let's see if we had taken this trade, how all of these things would have looked like. So here, this was our trigger signal where we had volume spike along with crossover of the MACD. Now defining our entry point, the price went down the next 2 consecutive days and retested the high of that specific day. This becomes our entry point, and now to define our stop loss as well as target, you have multiple options. The formula for you to be profitable in trading is a combination of 2 things. One is your risk to reward ratio and the other one is your winning rate. If you have only one of them, it is not sufficient. So here in this case, I am considering that our winning rate is around 60% and I would like to have a 1:1 risk to reward ratio. So coming back here, let me first measure what is the stop loss range. So the stop loss range is around 6.2%, which is exactly below the price of this specific red candle. And I would like to also have the target as 6.2%. So let's measure how much is 6.2%. 6.2% is approximately 2,759. So I'm going to shift this specific value to 2,000. Yeah, right? So this becomes our target level, right? So that's how you have to define your entry, stop loss as well as target even before you enter your trade. Stop losses are very, very important. A setup without stop loss is like doing skydiving without a parachute. It is very thrilling until it isn't. The final step of our framework is to decide if this trade is worth taking or not. Now, there are multiple factors that you can consider before you make this decision. The first factor is your risk to reward ratio. The second factor is your winning rate, and the combination of these two should actually be profitable. And this formula is called as edge. In the previous videos, we have already covered this. So if you are not aware of what edge is, please go ahead and watch those previous videos so that you understand how to calculate it. Once you have calculated the edge, there are 2 things you need to ask yourself. The first thing is, are you trading along with the trend? And second thing is, can you afford the loss financially as well as emotionally? If yes, then go ahead and take that trade. But if not, the next setup will come. Don't have FOMO. The best traders don't take too many trades. They take fewer trades, but always make sure they have a high probability of profit setup. So here's a quick summary of the 5-step framework that will help you create your high probability of profit trading setup. The first one is you need to identify the market structure. Is it in an uptrend or is it in a downtrend? Higher highs, higher lows, supports and resistance. Second, you need to spot confluence zones. Third, you need to wait for the trigger so that you can enter at the right point. Fourth, you need to define your entry, exit and stop loss even before you enter the trade. And fifth, check whether your risk to reward and all the other factors align so that you're going to decide if it's worth it taking the trade or not. Random trades give random results, but structured setups give the trader confidence. In the upcoming videos, we're going to dive deeper into entries, exits, as well as stop losses because sometimes timing is very important. If you found this setup framework helpful, then go ahead and like this video and share it with a friend. You're watching Stockshaala by Kotak Securities and I'm Pranav K and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.